Hello.
Hey, I'm Greg Galant. I'm the co-founder of Muck, which is a SaaS software platform for public relations, and the Shorty Awards, which are the awards honoring best of social media. And really excited to dig in here today with three great entrepreneurs and one great VC on how the relationships work between VCs, entrepreneurs, and anyone out there thinking about raising money or who already has. It's always a tricky relationship to keep up, so we're going to dive into all aspects of it. You heard from the entrepreneurs already, so I'd like to give Michelle a minute or two if you could just tell us about your background and how you got into investing.
Sure. I started my career actually in oil and gas. I was in the energy space right after I graduated from university, and after that, I went into the solar panel business where I built a solar panel.
Oh, I think we might have an audio issue. Hugh, do you want to just give her the mic?
Hello.
Are we good? Can you hear me?
No.
No. They can't hear me. It's okay. This will work. Does this work a lot better? How's that? Better?
Nice.
Okay. All right. So I actually started my career in oil and gas. I built a couple of exploration companies early on. And then I switched gears and I went into energy technology and I built a solar panel manufacturing business, which at the time was a little bit, out of the ordinary. And it was at that time I sold that business. My lead investor invited me to join him, and I spent the next 5 or 6 years building technology companies and investing them with him. So I learned the ropes on investing in everything from e-commerce to social media to enterprise SaaS models at that time. And then I switched into venture about almost 20 years ago, and just recently joined BDC, which is the Business Development Bank of Canada, which is a Crown Corp in Canada. And I head up a $250 million fund focused primarily on investing in women-led technology businesses. Those companies have to be headquartered in Canada, but we look for seasoned entrepreneurs or new founders that are interested in taking a technology business and growing it globally. And we invest from seed to Series B rounds, from $250,000 check sizes up to about $20 million in total investments raised. So that's really what we focus on. And BDC as a Crown Corp really has about $26 billion under management, focused in 3 areas: in finance, and so term loans into corporations, commercial lending only, advisory services, and then a big investment arm. So I manage one of the largest portfolios on the investment side. We also invest in clean technology and in life sciences across the spectrum. So that should give you a bit of an idea.
Great. And American VCs have a reputation for being very aggressive, like sharks. Are Canadian VCs nicer?
Canadians are always nicer. No, I'm just kidding. But we do have beer down there later if you want to come join us. No, being in venture is like any other business, right? We're entrepreneurs, just like others of you are entrepreneurs. We're just working to create value in a different way. We're not selling a product or service. We're selling a promise of being able to invest in great companies, help those companies have the capital and the added value resources that they need to be successful, and then help them get there. So, we work with lots of global venture firms around the world to make that happen.
Great. Now I want to kick it to the entrepreneurs, and we'll bring it back to you, Michelle. There are a lot of panels about how to raise money, but let's say you've raised money, be it even from your first angel or from a venture fund. Now you have a board of directors and people kind of looking at what you're doing. My question is, what are the habits and routines you guys have set up to keep up a good relationship with your investors? Is it you just see them at the board meeting and say hi and bye, and they're just happy with how everything goes? Do you do stuff between board meetings? What do you got to do to keep your investors happy?
Actually, I'm quite happy with the relationship I have with my investors. We had the first seed round with business angel. So 2 of them remain at the board today after the next 3 rounds, in total we did. And those guys, we had 2 options at the beginning, doing with VC or with them. And they were bringing, at the time, much more value for what we needed at the stage of the company. So it was really helpful to have them as entrepreneurs to help us not do take the wrong decisions they had experienced, for example, and be faster on picking the right company to help us. And then for the 2 next rounds we did, we choose some VC that we felt could bring some added value as well to the table because of the portfolio companies they were helping or the knowledge they had on our markets. And actually, we don't speak on a daily basis, but every week we exchange. 2 of my board members are coming 1 day every week to help us on a specific subject right now, and it's pretty cool to have them working actually for the business now.
Cool. And are you like texting with them, WhatsApp, Snapchat? Like what's your preferred method of communications?
No, it's pretty boring. Emails mostly.
All right, email.
They are not on Slack. Well, I don't know.
Do you invite them into your company's Slack channel?
Slack channel for investors we don't have yet. That would be a bit too much, I think. But no, they're really helping. Actually, they are working. They're not just here to check the numbers and say, okay, growth is fine, but you need to go and put more pressure. It's really they are working for the company, and I think we are both creating value for each other. So it's as long as you are aligned with your investors, I think it's healthy.
Great. Roland?
If I would add, SolarisBank is 2.5 years old, and when you start, it's different than when you have sort of finished a B round. So it's a journey, and as you grow at the beginning, you have a very intense relationship with your investors. But then when you add more players to the table, and we have at Solaris we have now 9 supervisory board members plus 2 observers, so that's 11 people. So you need to be institutionalized, and you need to manage those guys very strictly. And I would never let them on the Slack channel because any introduction or any question has to go through me. Otherwise, they just create a lot of dust in the organization, which keeps us busy, and you just don't know what you're doing then anymore. So, of course, you need to keep your key investors extremely close and happy and behind you, but then probably the smaller ones, it's okay to see them 4 times a year, and you drag them on as you go.
My experience in fundraising is it actually starts before. Any kind of communication, because it's not a transactional experience that you meet a VC for over drink or a board meeting, and next thing you know you have a check and then they're sitting on your board. So you have to build that relationship, and for 2 reasons. One is that what is that mutual benefit that company is looking for? What's the next milestone, and who is the right investment partner along the way? So having those conversations upfront, even before you have the formal term sheet or a check, is really critical. And that sets the basis of the things that you're talking about, whether it's the communication cadence, the KPIs, the goals, and those are the mutual alignment factors that are really important even before you raise a round. And once you do that, the communication, as Roland was saying, that could ebb and flow. Sometimes you actually front load some of that right after the fund is closed, your investment round is closed. And then you have a regular cadence of every other week so that you are checking in and sharing how the progress is being done. And at the same time, investors honestly are eager to contribute wherever they can. So for me personally, is that setting that expectation upfront, even before raising the money, is really, really important.
And do you invite them on Slack?
So in our case, not Slack, but it's all text, email, whatever is the communication preference. There's no formality at that point.
Cool. It'd be great to get their perspective from the other side.
I would not want to be on every Slack channel of every company that we have in our portfolio. We would die. The communication overload would be crazy. Now I think you're right. I think what we'd like to do is build a relationship before the investment ever happens, so that we understand you as a person, as the CEO who's leading the company. We understand the management team. This is a people business, right? This is not. I always say it's like a marriage, and I'm sure you've all heard this before. You're going to get married to venture for the next 7, 10, however many years, and you better like each other before you get into your situation rather than find out about all the warts afterwards. So communication is key.
And there's no divorce option.
And
right?
there's no yeah. Well, there sometimes are, but they're really messy, and you really don't want to go there if you don't have to. So, be upfront about what you want and what you need. And those needs are going to change, to Roland's point, over time and as the company gets built. So you're going to want to think about, and for us, we're the same. We're looking for companies where we're going to be able to add value, not just with our money, but with everything else that we can bring to the table, the networks, the access to other investors, corporate, strategics, and so on. So it's a long journey. It's not a short game.
Yeah, I'd love to invite you each to tell us about a time when you had a relationship, either if you were the entrepreneur and your relationship with investor went south, or vice versa, you were the investor relationship with an entrepreneur went south, and if you were able to salvage it, get the relationship better, and how you did it, or how you extricated yourself from the situation. Could be with your current company or a past venture.
Yeah, I can start. My learning has been that once as an entrepreneur, you're always excited, you're always thinking big, whether you're talking to investors, you're talking to your employees or your customers. But how do you keep it real, especially with your investors? And my takeaway is that especially if it is it's not if, it's when. At one point or other, you're going to miss your milestone, you're going to miss your KPIs, and you will go through that phase, and you want to make sure that you provide that information as early as possible to your investors. Investors see that entrepreneurs are always ever optimistic, and you may make a mistake of saying, okay, just another week, and I'm going to turn that around, and I'm going to make a positive news out of it. And even if that's the case, but telling and keeping your investors on point, on communication, especially when the KPIs you may miss, is even more important than you may hit your KPI. So that communication, especially when the news is not good, say that as early as possible, even if you have a chance of fixing it down the line. And that continues to build that trust between the two parties there.
I would refer to one specific conflict that every entrepreneur is faced with. And that is the moment you invite somebody to invest with you. You're aligned, but you need to be very careful and strong with managing expectations. Because if you then go into the next round, your investor will push you like mad in order to put out a plan that has a real high growth in your company because of the valuation that is going to be achieved with that. And that, if you over-promise, you will, 6 months later, you will pay the bill as CEO. Because everybody will look to you and say, look, you made that plan. Why didn't you deliver on that? So be strong, don't oversell. It's going to catch up with you. It's going to create problems. Be realistic, expect something that is real, and it will happen, achieve it, and then everybody will be happy again.
Yeah, I totally agree with that. Like one of the religion we have, same with my investor, is always under-promise, whatever, and over-deliver. It always has to be like good news, when we meet, because otherwise you create friction, they don't trust you anymore, and then you say, okay, you start to explain yourself, you don't want that situation. So the more you overpromise or do what you said, the more trust there is, and the less tension, and the more they believe in you, and they let you free. So because they trust you, you didn't bullshit them. So under-promise, over-deliver is what I would recommend. Like starting, if you are fundraising, never say, we are going to do that much if you are not 100% sure you will do it. Say a bit lower, and then when you see, hey, by the way, we did 20 million more than I told you last time. Okay. So that's a good way of starting, and then keep it all the way.
So Michelle, in your 20-year career, have you ever had an entrepreneur overpromise?
Oh, all the time. All the time. And it's not so bad if you can see the path together to figure out how to get to that milestone. What is bothersome, and frankly what pisses people off, especially investors and management team alike, is we had a case where we actually had another investor at the table of a company that we were invested in, And this was a clean technology company. It was a green solvent solution. So this company, unlike a SaaS company or something where the growth path could be relatively easily realized and seen, this was a company that was going to require hundreds of millions of dollars to get to market and was going to be 7 to 10 to 12 years in the making. And this other investor at the table happened to be a close personal friend of the CEO and was out in the market, unbeknownst to the CEO or the rest of the board. And this was not a BDC investment. This was with another firm, and he was telling everybody in the market, that the other venture funds that were interested in investing in the round, corporate strategic investors, and so on, that this company was going to be the next Google. They were already, way down the path with commercial relationships. Basically, set an expectation, unbeknownst to the CEO, that the CEO then had to go and defend. And it pushed back the fundraising for that company by about a year. And we went right to the wall in terms of their capital and the amount of money that they had available in terms of their run rate. So they were basically out of money because this investor who had, he thought he had the back of the CEO and was trying to do the right thing, but he overpromised in the market on behalf of the company. So it's another, I'm an investor, so I don't want to put down other investors, but I do want to say, managing expectations, but also making sure that your investors know what your message is as important as making sure you meet your targets. Because if the investors are out in the market promoting the company and helping to sell the company, helping to sell the story and the vision, they better know what they're selling. And a solvent company is not going to be the next Google, and that's kind of what this guy was out saying to people, and set a really bad tone in the market for that company. So you got to kind of, again, it's about alignment of interest, but making sure that that doesn't happen. So that was a bad start.
And just to play devil's advocate with this, I'm sure a lot of people out there have heard VCs say, look, I only want to invest in companies that can be really big. I'm counting on one of my investments to return the whole fund. Everything has that big potential. A lot of times when you get rejected, they say, it's a great idea, but it'll be a lifestyle business. It's not big enough for our firm. So, and all you guys raised a bunch of money. How do you raise a bunch of money without promising or setting the expectation too high that you then hang yourself on in 6 months?
Okay, I'll start. Well, if you have your vision, you have to stay consistent, because the round, you don't make it in 2 or 3 days. Usually it takes between maybe a month or 6 months, depends on how hot is the deal and the tension around the deal is. But usually it's between those areas. My strategy has always been to keep the same direction, same message, same consistency in the message, in the vision, because we don't have much things to hide, and under promise, over deliver. So each time I see them, I have another good news to say with numbers. Numbers is the best thing you can get. If traction is here, if you have green lights in your KPIs, it will do the rest for you. At some point, there is going to be a first mover or maybe 2 first mover, and then it's not over, but nearly, because when you have a first mover, then the term sheets are going around, and you take the best condition, negotiate the best condition, and then once you have them, make sure you take the best one you think you want to stay with, in terms of human being, and that's how we handled it.
I would add, look, you make your plan, and you make usually a 3 to 5 year plan, and on that basis you do evaluation. But then I think what is important is you choose your partner wisely, because there are partners out there that give you money and that's it, and there are partners out there that give you money, a network, and maybe access to other partners that can help you grow. So if you have that opportunity, choose that partner, because that might be a sort of the cream on the ice that gets you far beyond your plans that you have drawn up yourself. And there are great partners out there that are really helpful. And I can give you an example. When we did the B round, I had my chairman of the supervisory board. He was very knowledgeable of the investor market. And we raised 56 million, the two of us. And we didn't need an investment bank. And that was actually for the investors. That was a very important criteria to put money into Solaris. Because they said, if you actually accomplish a round with 56 million, with 4 partners at the same time doing an acquisition and a secondary, you guys must know what you're doing, must be knowing what you're doing. And that chairman was really good. He was helpful. He was a great asset.
I think, first of all, it's different when you're raising your first round versus you're in a growth round. So 2 different phases. So a couple of things. First of all, it's actually quality, not quantity. So when you're talking to investors, you have to really know your investor group. Because all these investors, they have their thesis. Whether they're going to be in biotech, whether they're going to be in retail, whether they're going to be in SaaS, so on and so forth. And second thing is at what stage they're investing. So yeah, if they're investing in late stage, they do expect it to be a billion-dollar company. But if your stage is seed, I think it's unrealistic for any investor to have that everyone's going to be a billion-dollar company. So look at the thesis, look at the stage, and then once you know those 2 things, especially in the early stage, it's about the problem that you're solving, the approach you're taking, and what is the solution that you have. Results don't matter at that point because you don't even have results. So those are the 3-4 things. Looking at the problem statement, your unique approach to coming up with a solution, and you have a joint vision, as Roland was saying, that we can assess and understand the company's valuation at that time. When you move from the seed stage all the way to Series C and D beyond, then you have a track record. You have the KPIs, and you have the growth projections, then absolutely you could be a multi-billion-dollar company because you have all the numbers to prove. So I think it depends on the stage, how you set the conversation, and be thoughtful about it. More about the problem statement, your unique approach in early and seed stages, and then you have track record in Series B, C, and D to actually prove that you could be on an escape velocity. Those are 2-3 things that I can share from my own learnings.
It does go to deliver on what you say you're going to deliver on. So if we're an opportunistic fund, and we invest from seed right through to Series B rounds, and we take a hard look at the company and the management team first, and then we look at things like what is the product market fit? Are you in market with a first customer validated technology, or are you $1 million or $2 million in revenues and growing? Because to your point, the needs of the startup company pre $1 million in revenues are going to be dramatically different than a company that's doing 2 or 3 or 4 million in revenues. And so we kind of use a sliding scale approach to see where we need to fit, where our best value is going to be added, and then where can we also find additional syndicate partners to come to the table to help participate in the growth of the business that are aligned with the same interests as us and the CEO. So particularly when we lead around, we will always be looking at who are the other people around the table, how does the CEO and the management team relate to those people, and then collectively, are we building a team at the board level to support management to execute on the strategy and grow it? And if it's a billion-dollar business, bonus. I would argue that I think billion-dollar businesses are hard to find. I think that we see a lot of $100 to $500 million businesses that are very, very good businesses. There's absolutely nothing wrong with that. There's nothing wrong with a company that is a $70 million business or a $50 million business that's valued at their market value might be $260 or $300 million, which in Canada we see a lot of because we don't have the critical mass and market capacity within the country in order to get to $1 billion. So I think you kind of have to set your own expectations and then look at your comps in the market to determine how you want to value the company, and then align your interests and the interests of your investors and your shareholders to support that.
Cool, and so we're low on time, but I figured we could just do a lightning round, 20-second answers. But what have you noticed is different now in venture? There's so much money flooding the market. Between on the high-end SoftBank, there's innovation with syndicates now. What's new? What's changed from a year ago? or is it all the same?
Well, I don't know about you guys, but I see a lot of new models in the market. So I think venture is evolving. There's a lot of new models where, and I don't know if you see this anywhere else in the world, but we're certainly seeing a lot of this in North America, where there are syndications forming among big angel groups that are putting a lot of money into an LPGP structure and then investing in a company and being able to stay sort of over 1 or 2 rounds. That's new. There's royalty-based lending models, venture debt models that we see a lot of, and I think it depends on the company, but and what you want. But those are some nuances that we're seeing in terms of structure and capability.
I mean, very quickly, the other thing that has changed in the last few years is that the initial inertia or initial investment needed from an entrepreneur to start a company. It's very easy based on the other infrastructure and innovations that you don't need significant amount of money to start a company and prove your idea with a quick iteration in first 6 months before even you raise money. That has changed in the last 5 years.
I would agree to that. Look at technology. Look at it 12 months ago. It's crazy. Stand up, do a 360, look around what's happening here. Unbelievable. And there's a lot of money out there, but you have to prove yourself. So not every crazy idea is going to be a good one.
Yeah, I agree with that as well. I mean, there are many good things with tech. It's opening many doors. We can do much more with less. I mean, it's look at your business. I saw your presentation. How quick can you disrupt a market? Maybe in 1, 2 years, 3 years, you are already a leader in the market in some places, because tech allows that. So I would recommend to find really the approach and make sure you are disruptive and that it makes sense. In addition, I would add. And then go for it. But yeah.
That's great. And if people need money, they can pitch you over the Canadian beer at the Canadian experiment. Great. Well, join me in thanking our panel.